All right, welcome everyone. We're going to kick off the tax webinar around passive activity here just in a couple minutes. But I know we're getting people logged in and loaded up. So my name is Chris Lopez. I am one of the partners at Property Llama. And I've also got Matt Amundsen here, as you guys know him, on the investor relations team and investor himself. Matt, why are we doing this webinar?
Great question. I think we're doing this webinar because so many people are looking at doing some more passive investing, adding some passive investments to their real estate investing strategy, and just getting to understand passive activities, passive investments, and how we can use passive losses for, I think, a lot of clarity on the real estate professional status as well, right? So just understanding how we can utilize the tax code to our advantage. And that's why we've got Brandon Hall from Hall CPA on here, the expert, to run us through all of these ins and outs. So thanks, Brandon, for joining us.
Oh, yeah. Yeah. I'm excited to be here. Thanks for having me.
Yeah. So as we're getting going here, so this is the second webinar in a 3-part series that I mapped out, I think back in January with Brandon and also Thomas. Thomas was in the first webinar. But as Matt said, we've had a lot of these, questions ourselves, investors, and of course, with all of our investors out there, just every deal is unique for the most part. And a lot of people are just lacking in good information, also like in a real estate investment friendly CPA. End of last year, we met Brandon and his firm Hall CPA, and they were a great fit where they were knowledgeable. And plus, something that we always get asked all the time is, do you have an account that's CPA friendly? And they actually have bandwidth to take on new clients as well. So it's been a really fun time doing the webinar series with Brandon, and excited for this one and to keep digging into details.
Yeah, man. No, this is going to be good. I do a lot of education on the passive activity loss rules because real estate investors need to understand how it works. A lot of people will come to us and they'll say, oh, my losses are limited. And that's not really, there's ways around that. So we can talk about that.
I like
we
that.
all good
I like
to go,
the attitude. Yeah, we're like to go. And I'd say one thing, tell us about yourself, because I also know like you have a nice portfolio of doors as well.
Yeah. So my name is Brandon. I started the firm Hall CPA back in technically 2015. I went full time into it in 2016. I was working at Ernst & Young at the time before jumping ship and doing this. But I'm a CPA. I have 24 units myself. So a bunch of small multifamily properties, and then a short-term rental beach home that we rent out and also visit from time to time. So we kind of like walk the talk at my firm, which is a little bit unique, I think. A lot of our clients really enjoy that because we'll take the tax hat off and just say, look, like, put taxes aside, this is a terrible investment. Like you should not, I would not buy this. You should not buy this. And our clients appreciate kind of the candor, I think.
Yes.
But yeah, that's been really helpful for us and ironically, I've hired a bunch of people that also invest in real estate. It was not part of the plan, but we end up with a bunch of accountants on our team that buy real estate as well. So yeah, it's been fun.
Well, I think that's very, very powerful. Like you say, you guys understand it from the tax angle, and also, like say, wearing the investor hat and doing it yourselves. I think that's very valuable.
Yeah.
All right. Well, we'll get started here. And I know we had over 150 people register for the webinar, and we got quite a few people live. So if you guys have any questions throughout, throw them in the chat box, the Q&A box. We'll monitor them, and we'll make sure Brandon answers them. But Brandon, talk to us about passive activity rules, because it is confusing.
Let's rock and roll. So why should you care? Why should you care about these passive activity loss rules? Because that's like a word salad. It sounds like a lot. So why does it matter? Everybody in the United States is subject to the passive activity loss rules. Every single taxpayer, which is everybody. But we don't learn about this until we invest in real estate 9 times out of 10. And that's because when we invest in real estate, the rental losses that are created from depreciation, they can either be deducted against our regular income, or they cannot be deducted against our regular income. And generally speaking, they cannot be deducted against our regular income. So what happens is we buy this real estate, we prepare our tax returns, we get this big tax loss. And then we get mad or upset that we can't use the tax loss to offset our W-2 job income or our business income, right? Like my CPA firm income. So why should you care is because understanding the passive activity loss rules, you don't have to be a technical expert to understand this stuff. My presentation today will put you on the right path. So you don't have to be a technical expert to understand the fundamentals of how this works, but understanding the fundamentals of how this works will make you extremely tax efficient as you scale your portfolio. And that's important because real estate is a very tax efficient investment vehicle. So if we can layer on this knowledge of how the passive activity loss rules work, we're going to be invincible from the tax side of the equation, which just means higher ROI, higher IRR from an after-tax perspective. So the passive activity loss rules created two buckets of income. All activities are either passive or they're non-passive. So think about them as like two islands, two buckets, whatever you want to think of it, but two separate, distinct activities, passive activities and non-passive activities. The passive activities come with certain limitations that prevent us from using losses. Okay, so anything that gets funneled into my passive bucket kind of gets trapped. Think about it like that. Like it's just trapped and you can't get it out unless you qualify for some exceptions. But the reality is that we don't want those losses to be trapped, right? We want to use those losses. If I have $1 of tax loss, I want that $1 of tax loss to offset $1 of income that I have. That would save me 30 cents between federal and state, right? So ideally, we get to use every single $1 of tax loss every single year. And that is a fully optimized tax position, right? Unless you're in just a super low tax bracket today and you're going to be in a high one tomorrow, and there's different considerations to play there. But most of the time, if I have $1 of tax loss, I want that $1 of tax loss to offset $1 of income. But the passive activity loss rules prevent us from doing that with rental real estate. The history of the passive activity loss rules is important to understand for the foundational piece of this. All right. So 1986, that's when the passive activity loss rules were implemented by Congress. The passive activity loss rules are under Section 469 of the Internal Revenue Code. The purpose of implementing the passive activity loss rules was to prevent rich people from using rental real estate to offset their income. That was the purpose. Okay. So Congress said, we're going to call rental activities passive activities, and passive losses cannot be used to offset any other type of income, is essentially how this went down. Before these rules came into effect, you could buy rental real estate. You could get the cost seg and the bonus depreciation. And I don't know if there's bonus depreciation back then, but if these rules didn't exist right now, you could get the cost seg, you could get the bonus depreciation. You wouldn't have to participate at all in the rental property, and you could use all the losses created from that cost seg and bonus to offset your regular income. That is what would happen today if we did not have the passive activity loss rules. Congress didn't like that rich people were just throwing all their money into real estate and getting these big tax losses and offsetting their income. Thus, the passive activity loss rules were created. And basically what they do is they say all rental activities are passive unless you qualify as a real estate professional, and any trade or business that you do not materially participate in is passive. Okay, so there's two types of passive activities. Again, all rentals unless you qualify as a real estate professional, and any trade or business that you do not materially participate in. So if you meet either one of those two definitions, it's on its own island, the passive activity island or the passive activity bucket. But our W-2 income, that's a trade or business that we materially participate in, right? My CPA firm, I run that full time. That's a trade or business I materially participate in. So that's over here in the non-passive bucket. My passive losses cannot jump out of the bucket and into my non-passive bucket. My passive losses are stuck in this bucket. Okay. So I can't use my passive losses to offset my regular income. That is what these rules do. Now, all rentals, unless I qualify as a real estate professional, we're going to go over that a little bit and here in a little bit. But that second one, any trade or business that I don't materially participate in, I want to spend 1 minute and just explain this. If I invest in my local hair salon, let's say I put $100,000 of expansion capital into my local hair salon and I get an equity stake as a result of that, the profits that they pass back to me are going to be passive because I'm not materially participating in this business, right? I just gave them expansion capital. I'm not voting. I'm not on the board. I'm not part of operations. I just go and get my hair cut every once in a while. I liked the product and thought it might be a good investment. Well, if they're passing profits back to me, that's going to be passive income for me, right? But that's that second bullet point. Any trade or business that I don't materially participate in. So I'm not materially participating in this business, thus it is passive. And I want to make that clear because sometimes you'll get like a K1 back from some investment you've made, right? And it'll say box 1 ordinary income, and your accountant might automatically say, "Oh, that's non-passive income." Because that's how this would look is the hair salon would give me a K1. And in box 1, it would say ordinary income, $10,000. And sometimes you have a tax preparer that will go, oh, that must be non-passive because it says ordinary income. But that's not how this works. Okay. You can have ordinary income that is passive. Simultaneously, the same thing happens when I get a K1 back and it has a big rental loss on it. Well, if I qualify as a real estate professional and if I materially participated in this rental activity, even though it's on a K1 and it says box 2 negative $100,000, that could still be a non-passive activity. All right. So the point is you can't just look at your K1 and say, oh, this is passive or non-passive based on where the numbers fall into what boxes. You really have to look at, did I participate in the activity? That's what you have to look at when you're trying to determine, is this passive or non-passive? So why are rentals passive? Well, when Congress implemented Section 469, the intent, again, was to prevent rich people from using rental losses to offset their regular income. And their thinking was, your rentals produce cash flow. Even when you show a tax loss, they're still producing positive cash flow. And that's totally true, right? Like we can have a rental that produces $10,000 of actual cash flow, actual net operating income, right? It's real cash that hit my pocket. But I can run a cost seg depreciation, bonus depreciation, and I could show a $50,000 tax loss. So I get to tell the IRS I lost money, even though I made a lot of money. Congress knows that dichotomy exists. They want to prevent you from being able to fully utilize those rentals to offset your regular income. So let's go through 2 examples real quick. It'll hit home. On the left-hand side, we've got revenue of 40, expenses of 30, depreciation of 20, net loss is 10. All right. If this is a passive rental, then the losses of $10,000 are suspended and they are carried forward. So passive losses that cannot be offset by passive income, because passive income in this example does not exist. Those passive losses are suspended and carried forward until they can be used at some point in the future. On the right-hand side, same numbers, net loss $10,000, but this is an example of, now it's a non-passive activity. And, it's just a high-level example, but just assume we qualify as a real estate professional and we materially participate in this activity. So now it's non-passive. And because it's non-passive, that net $10,000 tax loss, I actually get to use to offset my regular income. And if I'm in the 37% tax bracket, like many of our clients are, that's a $3,700 tax savings for me, right? And that's before we even touch the state level. So being able to use that $10,000 tax loss returned $3,700 to me. That'll either be returned to me whenever I file my return, or I get to reduce the total payment that I need to make by $3,700 to the IRS. So we're fully utilizing the tax loss and we're getting a tax benefit as a result. But on the left-hand side, again, it's suspended and carried forward because it was a passive activity. Now, if we add bonus depreciation to this mix, then the tax benefit becomes huge. Okay. So 2024, I think it's 60%. Yeah, it says right there on the slide. So we're 60% bonus depreciation in 2024. 2023, we were 80%. 2022, we were 100%. So after the 2017 Tax Cuts and Jobs Act, we had 100% bonus depreciation for any component with a useful life of less than 20 years. So what people would do is they would get a cost segregation study performed whenever they bought rental property, because a cost segregation study, the whole purpose of it is to basically identify of your purchase price, how much of that should be allocated to 5-year property, 7-year property, and 15-year property, as well as your building, your 27.5-year property. So the whole purpose of the cost seg study was, yeah, you've got this building, but not all the components in the building are going to last 27.5 years. Why 27.5 years? Well, that's how much we depreciate regular rental property over if we don't do a cost segregation study, right? So if I go buy $1 million rental property, I make an allocation to land because land does not depreciate over time because it does not deteriorate. Dirt is dirt. It doesn't fall apart. So I buy $1 million property. I allocate maybe $100K to land. $900,000 is allocated to the building, and I depreciate that by 27.5 years. Why 27.5 years? I do not know. Congress made that up. I'm sure they had plenty of research and studies at the time to suggest that that's the perfect time frame. But anyway, I write off $900,000 over 27.5 years in this purchase example. And so every single year I get a tax deduction, $900K divided by 27.5 years. I don't have to pay for it every year. It's just annual depreciation expense. It's a Vantum expense. It doesn't matter if I paid 100% cash for the property, financed at 70-30 or 50-50. The calculation for depreciation is the same every single year, 27.5 years. But a cost segregation study basically says, yeah, but in the 900K of building value, there are components that will not last 27.5 years. So let's go and find those components and allocate value to them. So after a cost segregation study, you end up with value allocated to 5, 7, 15-year property, as well as 27.5-year property and land. So you kind of split the 900K up even further. But bonus depreciation comes into play because you can immediately expense via bonus depreciation any component with a useful life of less than 20 years. So in this example, we've allocated 900K a building, 27.5 years. We've allocated some of that, let's call it $300,000 to 5, 7, and 15-year property. And now we can immediately expense it thanks to bonus depreciation. But that immediate expensing has even started phasing out, right? So 2023, it went down to 80%. 2024, it's now 60%. And then it's going to continue to phase out until 2027 when it reaches zero, or unless we get like an extender bill going through Congress, which we kind of had, but it's since stalled out. So we don't think that it's going to really pass at this point. But the point of this slide is, on the last slide, we had a $10,000 tax loss, right? Great, but whoop-de-doo. But now with bonus depreciation, in the first year of acquisition, we do this cost segregation study. We accelerate the depreciation schedule. We could use the same example as last slide, but now apply bonus depreciation. Now we have a tax loss of $50,000. And so our tax benefit becomes $18,500. A significant increase in the tax benefit by running a cost segregation study and using bonus depreciation. But again, the key here is that tax loss of $50K is non-passive so that it can offset my W-2 income and my business income. Otherwise, I've got a $50,000 tax loss from bonus depreciation that just gets suspended and carried forward.
So Brandon.
Yes.
You're a great teacher, man. This is great. Very, very complex stuff. So I want to pause here because, it's a lot of information you went through and it's dense stuff, but this is like, you want to learn the game here because we all see the headlines, billionaire real estate person pays zero in taxes or pays less. It's because they learn how to use depreciation rules and play the tax game. So I started learning like 3 or 4 years ago, and I've had a tax refund every year. It's totally changed the ability on how I can invest. I know Matt's done it as well, selling a bunch of rentals, and we'll talk about more, but able to reinvest, really offset a lot of the capital gains. So like, if you guys have any questions, post it now, because we'll go through more examples, but like that right there, like rewind that for 10 minutes and make sure you learn that concept, because it can be a game changer for like your bank account and also your investing strategy.
Yeah. Yeah. What you have to understand first are the fundamentals of passive versus non-passive. And if you understand that passive is trapped and you really want passive to be non-passive because that's where your real income is, your W-2 income and your business income, then the game just becomes, well, how do I get my properties out of this passive bucket and how do I move them over to the non-passive bucket? Or how do I add more things to the passive bucket. I actually just wrote a Twitter post about this, right? There's the long game here is I don't have to do anything spectacular. I just buy rental properties that are all passive, but then I go and I invest passively in businesses like that hair salon, right? Because if that hair salon investment produces $10,000 of passive income, and then I go and do a cost segregation study on a rental property, even if I don't qualify as a real estate professional, that rental property tax loss is going to offset the hair salon's business income. So if I can do the hair salon thing 10 times, well, then I've got a lot of passive income coming in that can be offset by my rental passive losses. And then I don't have to jump through any loopholes or anything like that. So it's really like that's long game. That's like dreamland where we all want to get to. But even then, we're still understanding the nuances of passive versus non-passive. And we'll continue talking about them here today too. But yes, if you can rewind the clock there 10 minutes and re-listen to passive versus non-passive, it will really help you in your investment career.
I got another follow-up for you on that one, Brandon. So you're talking about high income earners wanting to qualify for the real estate professional status. How do they have their demanding high paying jobs and then also qualify the amount of time to be real estate professionals? Are we going to
They don't.
Okay.
They don't legally. They either cheat or they have their spouse qualify. So if your spouse is like a stay-at-home mom or dad, they're not doing anything else, they can qualify as a real estate professional. And then on your jointly filed tax return, even though you work a full-time job, on your jointly filed tax return, you will be treated as a real estate professional. So that's how like high income earners that work full-time jobs or run businesses full-time like myself, that's how they qualify for real estate professional status.
Excellent. Yeah. Okay.
Or like I said, they cheat. and they cheat and it works until you get caught and then it's really painful.
Not personally a strategy I like to employ. I like to sleep well at night. So should we handle these questions as they come in, Chris?
Yeah. So I just saw a few comments about people saying it's fantastic.
Yeah, that one's good. And then I opened up the questions and someone is asking if we can briefly explain the bonus depreciation. I think we kind of covered it, but hitting the 5, 7, and 15-year property, and then the bonus depreciation, right? It's just you're able to take that depreciation and carry it into year one.
Yeah, exactly. So without a cost segregation study, I buy $1 million property. I allocate $100,000 to land, $900,000 to the building. And this is a random allocation. Don't just say, 10% land. Because if you're in California or San Francisco, 70% of your purchase price is going to be land. 30% is going to be building, right? So you have to look at the actual county assessor database to figure out how to make that allocation. But in my random hypothetical example, $100,000 goes to land, $900,000 goes to the building. $900K divided by 27 and a half years, that's my annual depreciation that I'm going to claim on that property. Now, I can do a cost segregation study and I can allocate maybe $300K of the $900K to property with a useful life of 5 years, 7 years, and 15 years. So what I'm doing is I'm accelerating. This is what if you hear the term accelerated depreciation, this is what this is. So I'm accelerating the schedule of the 300K specifically. So instead of deducting 300K over 27 and a half years, I'm going to deduct some of it over 5 years, some of it over 7 years, and some of it over 15 years. So for the first 5 years, my depreciation expense will be much higher than if I deducted the full 900K over 27 and a half years. But what happens now with bonus depreciation is any property with a useful life of less than 20 years, which is that entire 300K because it was allocated to 5, 7, and 15-year property, all of which have useful lives of less than 20 years. Bonus depreciation, I can immediately expense that amount. So what was happening over the past few years is we'd have a real estate investor go buy the $1 million property, do the cost seg study, and in the first year, they would claim a $300,000 tax loss because that was the bonus depreciation allowance. Now, you don't have to use bonus depreciation. That's why I kind of explained the accelerated depreciation schedule first. because bonus depreciation is like a layer on top. You can opt out of it though. I don't know why you would, but you can opt out of it. So it is optional. But that's what everybody was doing over the past like 5 years or so, is you buy a property, and especially in the large like syndicate space too. You'd buy a $10 million multifamily property and you get $3 million of depreciation. So you would kick back like a $2.7 million tax loss to your LPs. So if I put 100K into a syndicate, a multifamily syndicate, I'd probably get like a $90,000 tax loss allocated back to me in the first year, which is pretty powerful. So that's the high level on the depreciation. But even when I get that tax loss allocated back to me, if I'm in the LP syndicate, right? Or if I bought this $1 million property myself and now I've got a $300,000 tax loss, that's great that I have the tax loss, but now I have to apply the passive activity loss rules, because that's by default. All of those losses are in the passive bucket until you can prove it otherwise. That's the way to think about it. And it's hard to get it out of the passive bucket. So that's why I explained the passive activity loss rules to start, because they all get trapped in that passive loss bucket unless I can figure out a way to get them out. So I'm going to keep cranking on this slide, and I'll circle back to some questions in chat and everything. But I appreciate that, everybody that's jumping in there. So let's I just brought up the LP investment stuff. Let's talk about LP investments and how you can use LP investments strategically. So in my first example, I've got a physician that invests in a surgical center, but they don't materially participate in the surgical center, right? So remember our two types of passive activities: rentals and any business that I don't materially participate in. Okay, so I've got a surgical center investment that I'm not materially participating in. Well, guess what a surgical center investment does? It spits off a lot of cash, especially relative to my ownership. So I'm getting a lot of positive cash flow, positive income, but that's all passive income to me as the doctor. I can make LP investments in real estate funds and syndicates, get a tax loss allocated back to me, and I can use that tax loss to offset my surgical center income, because my surgical center income is passive and that tax loss is also passive by default, right? So that netting effect starts to happen. And that's what I said is like the long game for us. We really want to get that netting effect going. I've already used the hair salon example, so we'll skip example number 2. But example number 3, and this is specific to if I'm an LP and investing in deals, I can run something called the lazy 1031 exchange, because you can't, as an LP investor, run a 1031 exchange. When you invest in a syndicate or a fund, you do not own the underlying real estate from a tax perspective, at least. You own a stake in a partnership. So that's not real property, right? You can only 1031 exchange real property, but you don't own the underlying real estate. You own a stake in the partnership. So when you get the gain back after they liquidate and everything, you get the gain. You can't 1031 exchange your partnership stake. So what we do instead is we do something called the lazy 1031, or the lazy man's 1031 exchange. You get your gain back from syndicate A, and then you go and you take that capital and you just make a brand new investment in syndicate B. And syndicate B is going to run a cost segregation study. They're going to run bonus depreciation. And they're going to pass you a tax loss back, right? I put 100K in, I'm going to get 80, 90K back. It's going down every year now because bonus depreciation is phasing out, but I'm still getting a significant chunk back. I can use that tax loss to offset the gain from the other syndicate that liquidated. We talk about this with our clients in terms of I think we call it like the conveyor belt method. We have to like come up with a better term, but anyway, it's like stacking. So instead of, if you have 500K to invest today in syndicates, instead of giving all syndicates all 500K today, give a couple of them 150K today, 150K next year, 150K the year after that, because these syndicates will run 5 to 7 years. And so when they all start turning over, you've got all these suspended passive losses that you've already stacked up. So you can use losses from one investment to offset the income or the gain on sale from another investment. And so it's just the timing of receiving the gain and then receiving the loss from the new investment. But it doesn't have to be like the timing is just the same calendar year. So it doesn't have to be one after another. You could make the new investment on January 1st and then your syndicate that you're already in liquidates in December. Well, the gain from the liquidation still comes out in the same tax year that the initial that the investment in the other syndication was made. So the bonus depreciation is going to apply to the same calendar year, right? So as long as it's all in the same calendar year, you can use losses from one syndicate to offset the gain on sale from another syndicate. And that is high level how the Lazy Man 1031 exchange works.
Do you have to buy the property in the same year?
Same year.
Question.
Well, you don't have to buy it in the same year, but it all has to be placed into service in the same year. So I could buy a property on December 31st, place it into service on January 1st. And then when I do the cost segment bonus, it'll be as of January 1st.
So you can time the cost segregation to go the next year.
Yep.
Okay.
Yep. Powerful stuff. So kind of just talked about the timing aspect. So 150K in 2024, 150K in 2025, 200K in 2026. These are investments into syndicates. All right. And then here's the tax loss I'm going to receive with each one: 100K, 100K, 150K. So total tax loss is 350K over the next 3 years. Well, investment number one sells in 2028. Investment number two sells in 29. Investment number three sells in 2030. But look at what happens with 2028 and 2029. These tax losses, they were suspended because I couldn't use them, right? I'm just a passive investor. I'm not materially participating, and I don't have any other passive income. So the 350K gets suspended and carried forward. Well, when my first investment sells in 2028, I'm going to use 150K of the tax losses because that was the gain from, this is all hypothetical, right? That was the gain from my first investment. The gain from my second investment was also 150K. Well, I still have tax losses left over. So the point here is that if you time your investments, you could go many years without actually paying any tax. And in this example, I have two investments that liquidate over 2 years, and I'm not paying any tax on the gain because I have 350K of suspended passive losses until finally the third investment sells in 2030, and I use up the remainder of that gain, and I now pay the full tax on the overall gain. So you're still going to pay the full tax on the overall gain that you're receiving, but you're just kind of kicking the can down the road a little bit longer with kind of this stair-step approach, if that makes sense. Okay. Now we've talked a lot about passive losses and the rules and why they exist, but now I want to talk about how you avoid the rules. So there's 3 ways to get around the passive loss rules. And when I say get around the passive loss rules, what I really mean is, again, we've got those 2 buckets: passive, non-passive. Non-passive is where all my income is, my W-2, my business income. In the passive bucket is my rentals. So when I talk about avoiding the passive loss rules, what I really mean is we're taking rentals out of the passive bucket and we're putting them into the non-passive bucket. That way the losses can now offset all the income in my non-passive bucket. All right. So everything in that bucket now offsets each other. So this is where the magic is. There's 3 main ways to do it, and then there's a bonus. The first way to get around the passive loss rules is to sell a passive activity. When you sell a passive activity, the gain on sale is considered passive income. A lot of accountants mess this up. This is an area where a lot of people get messed up. The gain on sale from a passive activity is included in passive income, the definition of passive income. Okay. And what that means is I can use passive losses from other passive activities to offset the gain on sale of a passive activity. So that's where I get the limited partnership Lazy Man 1031. LP sells, I've got 150K gain. That's considered passive income. I can now go and throw 200K into a new syndicate, get 150K bonus depreciation allocation, and now I can offset the gain on sale. Okay. So you can use losses from one passive activity to offset the gain on sale from another. And here I'm using the term passive activity because, again, I don't want us to get locked into the term rentals. The passive activity rules primarily refer to rentals, but it's really important to understand that a business can also be a passive activity. Okay, because when you understand that, the whole world in terms of tax opens up to you. You start seeing how everything can just start offsetting each other. So don't get locked into it has to be a rental, and don't let your CPA or tax pro do that either, because then that's where they'll start making mistakes. The second way to get around the passive activity loss rules is to actually earn less than 150K. If you earn less than 150K, you don't have to jump through any crazy hoops. You get something called the passive activity loss allowance. It's a maximum 25K loss allowance that's only available if you earn less than 100K. And as you earn more than 100K, but in between 150K, that $25,000 loss allowance phases out. So if you're earning 155K and you're like, oh, I just need to get down to 149K, so I'm going to make a 401k contribution, you're not going to get a $25,000 tax loss. You're going to get a $500 tax loss. That's the way the phase out works. So the second option here, really beneficial if you're sub 100K in earnings, not so beneficial if you're closer to that 150K mark. Which then leads us to number 3, which is to qualify as a real estate professional, which we're going to talk about here in a second. And then the bonus is running a short-term rental. So real estate professional status. If you qualify as a real estate professional and you materially participate in your rentals will successfully be moved out of the passive bucket and put into the non-passive bucket. All right. So this is like dreamland. This is the apex of tax planning. This is where we all want to be. If my wife is a real estate professional, then we can use all of our rentals, the 25 or 24 that I mentioned, 24, 25, whatever number it is. We can use all those rentals to offset my CPA firm income. Very, very powerful, especially when you add in cost segregation studies and bonus depreciation to the mix. You can easily be talking about $1 million in tax losses to offset your income. Okay. But you have to qualify as a real estate professional and you have to materially participate. So to qualify as a real estate professional, 2 tests down at the bottom: spend more than 750 personal service hours working on the rentals and spend more time working on the rentals than you do anywhere else. Those are the 2 tests. So the second test, spend more time working on real estate than anywhere else, automatically kicks out anybody running a business full-time and anybody working a full-time W-2 job. Even if you believe you could spend more time in real estate than working at your W-2 job. And I believe that you could. I mean, I'd spent multiple years working 100-hour weeks building this firm. So you can do it. You're just not going to convince the IRS that you can do it. and if you don't convince them, you're going to tax court, and you're not going to convince the tax court judge that you can work more in real estate than your W-2 job. Many people have tried. Every single one has lost in tax court. Okay, so don't be the next person that thinks that they're going to be the one that proves the tax court wrong. So if you are working a full-time job, that second test, spend more time in real estate than anywhere else, that will kick you out of being able to qualify as a real estate professional. But let's say that you could qualify as a real estate professional. What actually counts for hours? This is like a big thing, a big deal with the gurus, tax guru space. I do a lot of educating on what hours count and don't count. And I'll give you some nuances here in a little bit, but the litmus test for determining what hours count and don't count is if the day-to-day operations of my rentals are unaffected by the time that I'm spending, then the hours do not count for real estate professional status, right? Because if I have to have 750 hours and more time in real estate than anywhere else, then obviously the next question is, well, what do I work in? What time counts? Does listening to this webinar count? Does listening to a podcast count? Does going to a networking event count? None of that time counts because it doesn't impact the day-to-day operations of your rentals. They're unaffected by you attending this webinar. Okay. And then I've got a little note down there. All hours are material participation hours, because I have seen some accountants out there say you have to hit 500 hours of material participation, because that's one of the 7 material participation tests. So you hit 500 hours of material participation and then 250 of anything else to get to your 750 for real estate professional status. And the theory is that the additional 250 hours could be education and research. And unfortunately, that's not true. If you hear that would be a failure to read the Treasury regulations and really understand what they're saying. So my point here is that 750 personal service hours is the same thing as saying 750 material participation hours. The hours that you log towards 750 hours, because if you're going to qualify as a real estate professional, you do have to log your time. It could be a Google Sheet time log, could be an actual app, could be your calendar, could be a written notebook. Doesn't matter, but you have to log your time entries like an attorney would. You have to do that to qualify as a real estate professional. So the hours that you're logging, they need to be legitimate operating hours, not the first 500 can be whatever and then 250 of anything else. No, the full 750 has to be legitimate operating hours. So let's talk about what doesn't count more specifically. Investor level hours do not count for your 750 hour test and more time in real estate than anywhere else. So that's time spent managing like your property managers, it's reviewing financials, it's bill pay, it's preparing tax returns, talking to my lenders, talking to my title attorneys. These are all things that any investor in any capacity would do. I'm not a real estate professional. I would still do all of those things, right? So that they're trying to draw a difference between what's actual operating versus what is something any investor would do. So investor hours do not count unless I am managing the property, the day-to-day property. So I don't have a property manager. If I'm managing the property, all of a sudden, all of those hours count. All right. So that could be a huge unlock if you manage the property in the first year of ownership. Nobody said you had to manage the property the second year of ownership, but that first year of ownership, you can get a huge unlock there. Education and research hours, that time does not count either. And actually failed to italicize these tax court cases. But here are tax court cases. Whenever you see a weird name versus commissioner, that's somebody's last name versus the IRS. So I'm not just like pulling these random, facts out of a hat. These are from tax court cases, tax court rulings. But education and research hours will not count either. And it makes sense when you think about it, right? That's like the easy time to log. I could sit here and listen to a podcast for 8 hours a day while I'm working and say that I did participation for 8 hours a day. But again, my rentals are still going to collect rent. Like if I didn't listen to the podcast, the rents will still be collected, right? The bills will still be paid. Like that's not going to change. So my education research time doesn't count. Travel time will also not count unless I'm self-managing my properties and they're all local to me. And that was lay versus commissioner, that bottom line there. The tax court did rule that in lay versus commissioner, they could count all their travel time because the taxpayer visited the properties every single day and they were all local to her. What does count? So here's the time that will count towards your material participation tests and your 750 hour tests. Hours that you spend acquiring the property, showing the property to prospective tenants, placing rental ads, taking applications, screening, negotiating, cleaning, maintaining, doing the repairs, doing improvements, asterisk on supervising the property manager. I'll come back to that. Purchasing supplies and materials, inspecting the property, communicating with tenants, collecting rents, evicting tenants, traveling again if it's local. Sounds a lot like a property manager when you look at this list, right? So don't get caught up in the FOMO that we often do when we enter different real estate groups and we hear, oh, this person's CPA is going to let them qualify as a real estate professional and they're a full-time physician or whatever. Don't get caught up in the FOMO. You actually have to manage the property if you're going to qualify as a real estate professional. Now, there is an asterisk that I did not include, but should be here. Supervising a property manager. This is not going to count if like I'm buying 3 properties out of state because it's way too expensive locally. So I buy 3 properties in the Midwest and I jump on the phone with my property manager once a week. That's not going to count. That's not what I mean by supervise a property manager. What I mean by supervise a property manager is like you are vertically integrating your portfolio. Property management is a significant part of your day to day and you're hiring a team to get it done. But think about this in terms of scale, right? So this isn't like I'm buying like a turnkey rental out in the Midwest and I'm going to call my property manager up and inconvenience them once a week because no property manager wants that. So just want to make that very clear because sometimes people are like, oh, I'll just supervise my property manager for 20 hours. So real estate professional status, again, the whole purpose of qualifying as a real estate professional is to move my rentals from the passive bucket to the non-passive bucket. That's the whole purpose. Because if I can do that, then I can use the rental losses to offset my regular income. Now, we just kind of went through real estate professional status. It is hard to achieve. You have to have 750 hours, personal service hours. They have to be legit hours, not the junk hours. But the caveat is that you also have to materially participate in your rentals. Now, when I used to do this presentation, everybody was always confused. What's the difference between real estate professional status and material participation? And there really is no difference unless you hit real estate professional status without being a landlord. That's where the difference is. Okay. So let's say that you are a real estate agent. That's what you do. That's your day job, or a property manager or a developer, right? That's what you do as your day job. So that is, and when I say day job, I mean business. That is 2,000 hours a year. That's all you do. You don't have any other side income or anything like that. Well, you spent 2,000 hours a year and more time in a real property trader business. So you are a real estate professional. If I'm an agent full-time, I'm a real estate professional. If I'm a builder full-time, I'm a real estate professional. If I'm a property manager full-time, I am a real estate professional. 750 hours and more time in real estate than anywhere else. I met those two tests. But my rentals are still passive unless I also materially participate in my rentals. Okay. So qualifying as a real estate professional, think of it as step one. Step two is showing that I materially participated in my rentals. These are the 7 tests for material participation. You have to meet at least one of them. You don't have to meet all of them, but you do have to meet at least one of them. So it's sad when we as tax professionals have to tell our clients, that's great that you are a real estate professional, but you didn't participate in your rentals. You didn't do anything. So they're still passive. So you did all this work. You qualified as a real estate professional, but your rentals are still passive. The tax losses are still going to be suspended and carried forward. So you always have to remember, I've got to go back and materially participate in my rentals, and you got to meet one of these 7 tests to get that done. All right. So that was real estate professional status and material participation. If you can qualify as real estate pro, and if you materially participate in your rentals, your rental will have successfully been moved from the passive bucket, and now it's over in the non-passive bucket. Now you cost seg, you bonus depreciate, and you offset all your income in the non-passive bucket. All right. So that's the big one to get over there. But again, the problem with real estate professional status is that second test of you have to spend more time in real estate than anywhere else. So that automatically kicks out everybody with full-time jobs, running a business full-time like myself. So we look to rentals that are not rentals, i.e. short-term rentals. Now, in this section, you're going to see some citations such as Treas Regs 1469-1TE32A. The reason that I am including these is 1, so that you can go back and cross-reference later, but 2, because you will most likely work with an accountant that does not understand this stuff. And I want you to be able to say, well, I was on this presentation and here's the actual regulation. Can you go look at it? Let them do some research, and then you can have a more sophisticated conversation. Because when you read this Treasury regulation, it says that as long as your average period of customer use is less than or equal to 7 days, then you do not have a rental activity under Section 469. Remember, Section 469 is the passive activity loss rules. An exception to Section 469 is qualifying as real estate professional. What I didn't tell you earlier, though, is real estate professional status applies only to rental activities. So if this Treasury regulation says, hey, if you have an average period of customer use of 7 days or less, then you don't have a rental activity. Now it's just like a business. Then what that means is I don't have to qualify as a real estate professional to make this non-passive. That's what this means. Okay. And the significance is, again, real estate professional status, the second test prevents us from using rental losses when we work full time, because we have to spend more time in real estate than anywhere else. But if I don't have a rental activity, and if I don't have to qualify as a real estate professional, then I don't have to work more in real estate than anywhere else, because that's only for real estate professional status. So the point is that if I'm buying short-term rentals, as long as I materially participate, right? So I do have to hit one of these 7 tests, because it's still passive until I hit one of these 7 tests. But as long as I materially participate in the short-term rental, then I can use the tax losses, cost seg, bonus depreciation to offset my regular income. And I can do that with a full-time job, because I don't have to qualify as a real estate professional, and real estate professional status is the thing that prevents us from using rental losses when I have a full-time job. But you do still have to materially participate. Big, still there. So what does material participation on a short-term rental look like? A lot of the same stuff, right? We're self-managing it. Sounds like a property manager. Managing the bookings, communicating with guests, taking photos, posting my listing, collecting rents, et cetera, et cetera, et cetera. If you outsource everything, you're in the same spot. Your rentals are still passive. Okay. So if you want to use your rentals to create losses, to offset your income, you have to either fully self-manage or play a significant role in the management. So a couple of material participation strategies for short-term rentals. One, don't hire a property manager, do it yourself. That's the most straightforward way to do it. And you can do that even at a distance. I do that with mine. My property is about 2 hours away from my home. Strategy number 2 is apply strategy number 1 to only the first calendar year. And then after that, you can go back to passive management, right? You can put a property manager on in the second year, because material participation and everything that I just talked about is evaluated on a year by year basis. Nothing carries forward, nothing carries back. Once December 31st comes, whatever you locked in is what you get. So if you think about it, it's like, okay, well, I can materially participate in the first year, make sure that I can strip out all that depreciation with the cost seg study and deploy it or use it against my regular income. And then I can put a property manager on it next year, and they'll just manage it passively after that. Because I've already extracted the tax benefit, right? I've already pulled out all that depreciation in the first year.
So you're saying that essentially in that second year, because you're not really being able to take those benefits, it's okay to then classify it passively.
Exactly. Yep. So the first year is when it matters, because that's the year that I'm going to extract all the benefits. Now, Matt, I think you might have asked, or maybe it was Chris, one of you asked, well, could you do a cost seg at any point? And you actually can do a cost seg at any point. And that's another, I don't think I have this anywhere in this presentation, yeah. But if I bought 5 properties back in 2022, I could do cost segregation studies today in 2024, and I could apply all of the depreciation to 2024. So to answer your question, Matt, you want to materially participate in whatever year you're going to run the cost seg and the bonus depreciation. That's when you want to materially participate.
Yeah.
This is just we don't have to spend much time on this, but depreciation of a short-term rental is 39 years, not 27 and a half years. This includes all the nuances as to why, and includes some citations. But the big point down here is that this last bullet point, when you have a 39-year depreciation schedule, you can immediately expense improvements such as roofs, HVACs, and fire protection systems. You use Section 179 to do it, and there's some nuances to that as well. But just know that if I have a short-term rental, and I should be depreciated over 39 years. So I'm doing that. I replace my roof. I replace my HVAC. I can immediately deduct the whole cost. I don't have to depreciate it over 39 years. And that is a massive benefit over residential rental properties. Because on my residential rental properties, those are 27 and a half year properties. I can't do that. If I install a new HVAC, I have to depreciate it over 27 and a half years. A long time to recover that cost. You do have to watch out for the personal use of short-term rentals. So if you use the property for more than 14 days during the year, you could significantly limit yourself to the benefits that you can claim. So just be aware of that. And I'll send these slides. You have these slides, Chris. You can send these out to everybody so you can read a little bit more about it. But the main point is, if you're going to use your rental for more than 14 days a year, be really, really careful, because you might end up stepping on a massive landmine. When you first show this to your accountant, if they don't do a ton of this, they're going to go, okay, great find that your rental is not a rental activity under that Treasury regulation. So now I'm going to put it on Schedule C where it should go. The problem is that's incorrect reporting. Most of these short-term rentals should be reported on Schedule E, just like every other rental. But your accountant is going to think, well, it's not a rental, though. You said in that Treasury regulation, it's not a rental, so therefore it should not be on Schedule E. It's still a rental. It's just not a rental under Section 469 specifically, but Section 469 is kind of like on its own island. It's the way some of these code sections work with the Internal Revenue Code. So don't let your accountant throw your short-term rental on Schedule C, because if you throw it on Schedule C, then guess what? Next year, after you strip out all that depreciation, you're going to have big taxable income from the cash flow. And now you're going to subject it to self-employment tax, an extra 15.3% self-employment tax. If you're running a hotel or like a boutique hotel, okay, that's where it should go, Schedule C. Most of us are not doing that. So it could be a short-term rental, it could not be a rental activity, and it can still be reported on Schedule E. So it's a little confusing, but just want to make that very, very clear. Here's additional information on it that you can read if you get challenged. I included all of this because I was doing this presentation over the past couple of years, and people are like, oh, my account doesn't believe me. So here's the citations that you can run through with them. And here's an additional citation that you can run through with them as well. And this speaks to the specific code section that this is all in, section 1402A. So short-term rentals, Schedule E. I'm going to skip these myths just in the interest of time, but you can go through them on your own, relatively straightforward. This is my contact information. You can scan for a consultation with your phone. Or you can hit up our website down here, therealestatecpa.com. I hope that this was helpful for everybody. And if we've got questions, happy to stick around and answer them.
Yeah, Brandon, this was great. Thanks so much for hopping on here. So a question from Scott. LP investing is always passive by default, correct?
Correct.
Great.
So he also asks about depreciation recapture. So when you sell the investment that enjoyed the bonus depreciation, you still have to add back all of that depreciation via recapture. So you will eventually have a big tax bite unless you keep making passive investments to offset the gains.
Correct. Yes, exactly. And actually, we're seeing the Scott right now with some short-term rental investor. So our stance on depreciation recapture has always been, you don't need to fear it as long as you plan for it. So everybody going in should know, we're going to extract this with bonus depreciation. We're going to get this big tax loss, going to create a lot of tax savings. And I'm going to take the tax savings and I'm going to reinvest them. Even if you don't have to put them in real estate. You can put them in equities, put them wherever you want, but reinvest them. Don't use the tax savings to buy a Ferrari or a boat, right? Or go on an expensive trip, because what we're seeing now in the marketplace is new investors or new clients are coming to us and they're saying, hey, I bought property in the Smokies and I did the short-term rental loophole. But now my property, I bought it for $900 and now it's worth $850. And it's not renting as much as I thought it would. So I'm looking at selling it. Can you guys help me calculate what the loss would be and how that would benefit me? The problem is that if you bought it for $900 and you sold it for $850, you might think, oh yeah, I've got a $50,000 tax loss, right? But what an accountant goes is, well, you bought it for $900. How much did you bonus depreciate it? Oh, you bonus depreciated $150,000. So your adjusted basis is $750. So you're selling it for $850. Your adjusted basis is $750. You actually have $100,000 taxable gain. That's what you have when you sell this property at a loss, because you stripped out all that depreciation at the beginning. So the point is that if the benefit that you received from the depreciation was reinvested, or just taken care of, it doesn't even have to be reinvested, but just taken care of, the depreciation recapture should not be an issue. But what we're seeing is, like in this particular example, I bought it for $900. I'm selling it for $850. That depreciation benefit that I received is gone. That was a trip to Disney World. So now I've lost money. I've eroded my equity, and at closing, I have to come out of pocket another $40,000. Where do I get that money? That's the challenge. So it's a really good question, Scott. Yeah, you have to be careful with the bonus depreciation, but you have nothing to fear if you take the money that you've received, the tax savings, and keep redeploying it. To totally avoid bonus depreciation or depreciation recapture, to answer the second part of your question, you can 1031 exchange. You can do the lazy man 1031 exchange. You can keep buying. Then you just kick it down the road indefinitely. You can flip it into opportunity zone funds for a little bit more of a passive hands-off approach. There's a lot of ways to avoid it. But if you have to sell and you can't avoid it, hopefully you took care of the savings from the beginning.
To that opportunity zone question, this came up with an investor the other day. So if you get into the opportunity zone, are you then only wiping out that depreciation or that gain going into it, and then you're paying taxes on the gains on the opportunity zone, or are those gains then also tax-free?
You have to pay tax in 2026 in that year on any gain that you roll into an opportunity zone fund. So you do have to pay tax on all that recapture and all the gain that you roll in. But the additional, like the opportunity zone fund itself could do a cost segregation study. And in 10 years, if you hold it for 10 years, when your additional gain is eliminated, that also includes your depreciation recapture. So opportunity zone funds can be extremely powerful if you hold for 10 years, because they can do a cost seg today, pass you a ton of tax benefits, and eliminate the recapture on a 10-year hold, as well as the additional gain on your investment.
And what if you 1031 into the opportunity zone?
If you 1031 into the opportunity zone, I believe that you have to, that's actually a good question. Well, you can't, I don't think you can 1031 into the opportunity zone. Well, how would you? Yeah, I don't know that you'd be able to do that, because that would be exchanging real estate for a partnership interest.
Well, in this particular case, we're talking about doing it as a tenancy in common.
As a TIC? Yeah. That's a good question. I don't know. It's a really good question.
I stumped you.
Yeah, you stumped me.
This is good. I mean, yeah, don't feel so bad that this one stumped us the other day.
I'm actually right after this jumping on a podcast with an opportunity zone like sponsor. So I'm going to ask him this question. That's great.
Great.
Yeah.
Brandon, this has been fantastic. We are just over the hour mark. So thank you. This was a jam-packed webinar, and quite a few compliments in here saying, hey, you basically took a lot of times a dry subject, made it very entertaining and engaging. So we all thank you here for that. I look forward to having you or someone else from Hall CPA back on for the third webinar, and also just some more ongoing education. So thanks so much, Brandon.
Thanks,
and if
Chris.
you guys have any questions out there or need help looking at your taxes or real estate CPA, definitely go reach out to Hall CPA. We've already had a handful of clients I know of reach out to them. Some are using them, some are using their tax strategy services. But if you're not sure, if you're looking for a new CPA, I would definitely put Hall CPA on your reach out list.
Thank you.
Cool. Thanks so much, everyone. Have a fantastic day.